Welcome to our December 2025 podcast. I'm Carly Purcell.
And I'm Ryan Sheffer. Thanks for taking some time to tune in to something that's so important to you, to your invested assets with us. You're going to notice we're light a member of the team today. Derek Van Salkema got caught in some Midwest winter weather, so will not be with us today, but we hope he gets home safe to his family. I think we'll do all right together.
I think we'll be okay.
All right, I think we will. And you know what? The month of December, it's a great way to cap off the year, but there wasn't a lot going on the month of December.
Yep, not much.
No, not much. So with that being said, you just got back from a little bit of travel.
I did. I visited my dad in Las Vegas.
Wonderful. The weather was, I assume, different than it is here.
Weather was gorgeous, 75 and sunny.
Yeah.
It was great to get out of Michigan for a few days during the snowstorm.
Perfect. And you got to see your dad.
So and I got to see my dad. So,
well, that's wonderful. Let's go ahead and jump into the things that matter to your portfolio. We always like to do a market update for the month of December. Like I said, not a whole lot to unpack here. A bit like watching paint dry. Actually, there's always a wonderful headline written by the media that you can interpret a number of different ways, but it really didn't move the market a whole lot. So there's always some excitement you can find with respect to the financial media.
Don't get caught up in the headlines.
Thank you. Such an important thing to remember, because they are what? A headline designed to get you to click and look and see an ad, quite frankly.
Grab your attention.
Right, exactly. And it's interesting in the roles we play in your lives, how the phone calls sometimes are just driven by headlines.
Yes.
That's interesting. But hey, the S&P 500 was about as close to flat as you can find, up 0.06% for the month. It's the top 500 companies in the U.S. And remember, when you invest in a stock, you own a piece of a company. Stocks are called equities because they represent ownership. Now, the opposite side of that would be a bond, if you will. So we like to look at the bond market as studied by the aggregate bond index, a basket of bonds. When you buy a bond, you're lending money out. Somebody pays you interest, gives you your money back at the end of the agreed upon time period. Bond market was actually a little bit negative, down 0.15%. So yet again, about flat. But still, when you unpack the 12-month runs on both the S&P 500 and the aggregate bond index, we had another good year.
We did.
The S&P locked in a return, around just shy of 18%, 17.88%. The aggregate bond index, go figure, bonds had a positive year. Yes. Aggregate bond index was up 7.3%. So you're starting to see, and we've talked about this a few times now, that the bond market, it's kind of like, hey, you can get back in the water a little bit. And there's a reason why, and we'll talk about that. With everything, things can change on a dime, but we're starting to see some actually productive movement in that space. So that's the market. What about your portfolio? Well, not a whole lot of movement in the month of December. A little bit, but we were more setting up for the lens that we see for 2026. So you might have seen a few sells come through in December. That's just us getting ready for kind of some movements that are more structural in nature that should set us up in the new environment. Just because we have a fund that plays a position, whether it's an exchange traded fund, an ETF, or a mutual fund, if the fund isn't delivering to you, it isn't keeping up with our expectations, guess what we can do?
Make a change.
There you go, and fire it. I was looking, at some point you earn your way out of the portfolio. But let's just assume that we have a large cap growth manager and we give them a year and they have an okay return. That's not what we settle for. We strive for greatness in your portfolio, and there's a point of time at which we make a change just based on that evaluation. So we could be right directionally and with the asset class, but we just need to always have the right managers and investment vehicles working for you. So the beauty of it is we are a fee-only fiduciary. So any of the moves we're making in the portfolio, they're in your best interest. We can prove that in front of regulatory bodies. So that's what we're doing, and that's what we love to do.
And what did we discuss about the transactions that the clients see?
Oh, yeah. So Carly and I oftentimes will just have all sorts of conversations, but one of the conversations we recently had was transactions that you're notified of, whether it's in the mail or electronically, they don't always add up. Because, for instance, if we buy an exchange-traded fund, an ETF, love them, can trade them intraday, they're low cost, no transaction fees, anything like that. But one of the drawbacks is you've got to buy them in
whole shares.
Right. So the math doesn't always work. You might be $100 off. But Carly, if somebody goes and adds up the buys and the sells and they're a little bit off, what would you always tell somebody?
It's just strictly going into a cash account within your account. The funds are still there.
There you go. Yep. So anyway, it's good to be aware and paying attention, but the scientific study of all these sells and all these buys should add up to the penny. That's just not the reality of it, but all the money remains in your account. So that's wonderful, and it allows us to really, again, do what we're here to do, which is manage for you. So that's portfolio update. Be ready. You'll start seeing that stuff into the new year. So let's talk about December and the irony of it being just such a sanguine, it was a month of really going nowhere. Mm-hmm. Now, granted, like I said, you always have those headlines. The headlines are always there, but the market really didn't move a whole lot. And there's some wisdom in that. Just because there's a headline doesn't mean that the market needs to move. And the headline isn't always touching the important thing to the market. But I think the irony really is when you zoom out and look at the whole 12 months, think of how this year started. We had a very, very challenging election for society, right? It was very divisive, and we got through that.
We did.
But then, we get into, okay, now we're moving forward with the new administration, and things are changing, tariffs are being enacted, and the market's going crazy.
Right.
Right? That was hard. That was really hard. And then we, repaired and we were able to move back. But the issue is to end such a challenging year with such just a month of nothing. That's the irony. And guess what? Markets often take the most ironic path. So maybe it's fitting. But I guess we'll use this moment to bring the point up that you have to be disciplined when it comes to your investment approach. You have to have a strategy when it comes to your investment approach. And I can't believe I'm going to do it, but I will quote Mike Tyson. Everybody's got a plan until they get punched in the mouth. And what this speaks to is just it's hard to follow your plan when really challenging things are right at your doorstep, right? That's why we can't have an emotional response to the things playing out in the investment world. We have to have a business approach. And that business approach is driven by a strategy, and then we follow that strategy in a disciplined manner. Through that whole April timeframe, Liberation Day, all the wild movements in the market, a couple things ended up being our North Stars. And if you go back to those months and listen, you'll know. But I can see you looking at it. You want to know, don't you?
I do want to know.
You want to know what the North Stars were. It's basically the money supply never backed off. And that's very, very important to the market movements that we've experienced over the last couple of years, quite frankly. How many dollars are out there in the system? How many dollars out in the global system? And they might not be dollars, just global currency. So that money supply never tightened up. Very important to watch. And then we did not see a lot of stress in the banking sector.
Okay.
Those two things were able to be our North Star. And then there's a lot of other inputs and influences. But watching those allowed us to tune out noise and focus on signal. And it paid off. Go figure. And that's why asset management exists. We cannot react emotionally. We have to have a plan and follow it.
And what do we tell clients who are acting emotionally?
To stop it. That's what you say, right?
Yes.
Yeah. No, it's just, again, turn off the news, right?
Yes.
That's what you're probably going for. Turn off the news. And there's a time to react. There's a time to change. There's a time we have to be open to all of that. We have to be like water. We have to be willing to adjust and adapt. But do it when it makes sense. Don't do it just because, some TV program you tuned into told you to.
Right. Headlines are tough, and we understand that.
Yeah,
but
we understand. Make a phone call. That's all you need sometimes. A little pep talk.
What do we always say too? We're playing the long game.
Oh, yeah. If you were invested for tomorrow or next week, owning stocks isn't right. It's not timing the market, it's time in the market.
Correct.
Right? So we got that. Now, where do we get our outperformance? In that time, owning the right things in the market, right? But we got to give it time. So that's been good. Now, if you think about the month of December, there were some economic data points that came out, and they're always delayed. So the stuff we see in December is for November. But still, what we saw was a robust consumer. Inflation that has settled in a bit. Yeah, there's embedded higher prices, but I think that the policymakers out there are more worried about continued inflation. Could it come into the future? Sure. But for now, those things have settled down, and you're starting to see that translate into with that strong consumer. Corporate America is looking good. We'll unpack that in a minute. And so you're starting to see some really positive things when it comes to GDP and stuff. So the economics, not only for December, but for 2025 have remained resilient. Probably the most important, well, not probably, the most important economic element is the consumer and the strength in the consumer. So Carly, when you're going out in the world and deciding to buy something,
Yep.
you standing in lines, or is it
Sadly,
empty?
I'm standing in lines.
Okay. Me too.
Yeah.
Me too. So what does that tell us? That people are out there trying to buy stuff right alongside us.
They're spending money.
That's right. So sometimes the most simple observations are really all you need to at least trust the data, if you will. And so what we're seeing is the economics standing tall, and in the month of December, for November, we saw that, but really for the whole year. And that has been something you had to pay attention to, okay? Now, the consumer and the person standing in line next to you buying whatever they're buying, that's going to translate into something, because you are in a store typically, right? And when something gets sold there, that store is making money. Remember what we talked about when you own the S&P 500, you own those top 500 companies, right? So if you own a stock and they're selling things, quite frankly, you're selling things. And how do we know how many goods or services were sold? Well, companies report earnings, all right? Quarterly earnings. So we just closed the fourth quarter as of the 12/31/2025 mark. We don't know exactly how corporate America's earnings went, but everyone is anticipating a record earnings report, and that's across corporate America. And that record would be beating the third quarter of 2025. So as the market has moved higher, corporate earnings are keeping right up. And it's amazing because everybody has forecast that they're going to relax. So Carly, your observations are very much on, and it'll be interesting to see, and we'll report to you exactly how corporate America did, but it's anticipated that it's going to remain robust. So that's wonderful.
I plan to continue shopping.
Oh, well, thank you for the stimulus. Thank you from everyone for the stimulus. All right. No, that's wonderful. So I guess this wouldn't be a December podcast without kind of just the summary of 2025. And we keep alluding to it. But 2025 was another great year on the heels of a couple good years, but think about the challenge that we went through in 2022 to then get 2023's robust return. Then 2024 was pretty volatile. 2025 was certainly volatile. And in fact, I think some of that volatility on the front end of the year actually stole some of the return that we would have gotten in 2025. All that volatility in the first part of the year really turned, I think, a lot of investors off to the whole idea of seeking opportunities in the stock and bond market. And whether it's a political skew or I don't know, don't care, quite frankly. Doesn't matter. But there's a lot of money on the sidelines still. So even with that robust return, I do believe that meat was left on the bone that I think we can carry over into 2026. So we talked about having a very disciplined approach to your portfolio, watching the things that mattered in 2025. It was really, really important. I don't know that it was that hard, because the things that have been driving the market really since 2023 were the things that kept driving through 2025. So just study them, be aware. At this point, I could tell you where they're at in my sleep. I've been looking at these things for so long. But 2026, probably a lot of the same to a degree, but I think we're going to bolt something else on. But let's unpack yet again what those things were for 2025. A robust fiscal stimulus plan. That is Congress spending money. We are still operating with a major deficit as we run our country, right? You'd expect there to be a virus or a war or something like that right here on our shores, but there isn't. So that's all stimulus. If the government is spending more than they're bringing in, what are they doing for the difference, the margin? They're creating the money. So that is where you find that stimulus. Again, economic backdrop is robust, probably has to do something with that stimulus. Consumer is robust, corporate America is robust. So all of those things are looking good. But in 2026, something very big and pivotal does happen, and it surrounds the Federal Reserve. I've talked to you a little bit about it.
Yes.
Yeah, there'll
Jerome
be
Powell.
yeah, there you go. All right, you know it. Yep. Jerome Powell, changing of the guard. Jerome Powell's term will be up, and the president will be able to name his successor. I believe that'll happen pretty shortly into 2026. One of the things Jerome Powell has navigated for many years, he was appointed under Trump's first term and has navigated through some very challenging environments. And quite frankly, he has caught a lot of criticism and things like that in the media. Warranted or not, we're not here to talk about that. But the bottom line is it hasn't been a very smooth ride for him. Certainly hat tip to him and his commitment to doing the best that he could out there. But his time is up. And in May of 2026, we will have that changing at the chairperson of the Federal Reserve. We don't know exactly who that's going to be, but I can almost guarantee, and there's not really anything I can guarantee in this world, so I'm very confident in that individual will be lowering rates very aggressively. Because again, the president gets to pick that successor. So that unlocks an entire gear of what's called monetary stimulus. So acts of Congress, fiscal stimulus, acts of the Fed, monetary stimulus. That's something that we haven't had a tremendous amount of in the years prior that I think we're going to get in 2026. And so how does that weave into what we're currently dealing with? And I think that the report is that there's always going to be volatility. And there's always going to be things that exist outside of what we manage the portfolio to. We'll call them fat tails. Think of that bell curve, and then the tails, those are called fat tails. You react to those risks. You're proactive about the opportunities and risks that probably will happen. Sometimes you got to be able to react though. But I think that you're going to see a lot of the things that have worked continue to work, but there's probably a whole new element that we get to experience. So that's summarizing for 2025. I think one last thing before we really get into the looking ahead and making some predictions for 2026. One thing that has been very interesting as we've rounded out 2025 is the stability in interest rates. You know, we like to look at the 10-year Treasury bond yield, right, to try to just gauge the entire interest rate market. And we've seen that become range bound. And that means that interest rates are accepting the economic backdrop that we're faced with. And that's really important because interest rates get so scared about inflation and policy uncertainty. When there's just messes in those two realms, you will never find interest rates trending and finding like a range. And that stability translates through a number of different things. Number one, it can help stocks. But number two, it really allows for corporate America to understand what their cost for borrowing is going to be. And the most impacted from interest rate volatility are small and medium-sized companies because they often have floating rate, revolving debt. So their rate adjusts with the interest rate environment. Well, if interest rates go down, and they're out selling products, well, guess what? They get to keep more because there's less interest cost. So maybe that's one of the opportunities that we see for 2026. So
if rates are cut for our clients day to day.
Yep.
Car loans.
Car loans, that's a good question. So car loans, what you got to remember this. When interest rates are cut by the Federal Reserve, it's just the overnight funding rate. So it's that overnight funding rate. It's the most short-term rate out there. Then the remainder of the rates are set by the market. That's why we kind of watch the 10-year because that's the market rate. But when the Fed is moving interest rates, that's kind of that overnight policy rate. Think of somebody holding a kite. Your hand is that anchor point, that overnight funding rate, and then the kite is like the 10-year. Just because you move your hand down doesn't mean the kite's going to go. What are the winds doing? Right? So remember, when it comes to the interest rate, money market rates will drop first. Car loans, things like that, they're kind of more on the market-driven side. Mm-hmm. So they won't adjust right away, but like prime will start to come down.
Correct.
Right? Those are the rates that are policy-driven, that are linked to that federal funds overnight lending. Great question. But you got to give it a little time for those interest rate decreases to find their way into just the lending that we engage with. Great question. Great question. So looking ahead, I think that we're very productive for 2026. I think you should be too. I think that there is always going to be volatility, but let us unpack that volatility and see it for what it is. Not the emotion that is driven by the headline, but the business that the body of that article would really impact, and it might be nothing at all. So it'll be an honor to get through 2026 together. Thank you, Carly, and thank you all out there. Appreciate it. Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thanks for tuning in. We'll see you next month.